over the years, I've read study after study after study of how often investors do worse or have worse returns than their actual investments, whether it be an individual stock or maybe a fund that they invested in, whether it's a mutual fund or an ETF. And I know that you're probably thinking, well, how does that happen if they're actually invested in that? Well, the simple answer is bad timing. People often think that they can time the market and buy and sell and beat the market, right? But invariably, this line of thinking, combined with the inability of some investors to stomach volatility, has generally cost the majority of investors a great deal of money over their lives. For instance, according to Morningstar's annual Mind the Gap study, released in 2023, they state that bad market timing cost fund investors 17% in gains over the past decade. So the average fund gained about 7.7% per year over that 10-year period that ended in December of 2022, while the average dollar invested in mutual funds or exchange-traded funds actually earned 6% annual return. So that is a 1.7% gap, or 17% over 10 years. And again, this is as a result of bad timing of investors buying and selling. And as a result of this timing, investors missed out on about 1/5 of their investment returns, which is a significant shortfall in the investing world. Now, Jeffrey Tack, which is the chief rating officer for Morningstar Research, states that one of the clear takeaways from this study is that investors are more likely to mistime their investments in highly volatile funds than they are in less volatile funds. So again, volatility adds to this as well. Right? Because when you want to sell, sometimes people want to sell and they think things are way high. And sometimes people see stuff going down and nobody likes to see their money go down, right? So they're like, hey, get me out, sell. But invariably that is the wrong move. And Morningstar calls this minding the gap. And Carl Richards calls this the behavior gap, which of course refers to the difference between investment returns and the returns that the investor actually achieves due to their behavior. So again, it's the variance between the performance of an investment and the performance that an average investor in that investment actually experiences. This gap often occurs because of the emotional decisions made by investors. For instance, during market fluctuations, investors might react emotionally by buying or selling investments at inopportune times, driven of course by fear or greed, because that's what drives everything, right? Fear and greed. Now this behavior can lead to buying high and selling low, which of course is the opposite of what we want to do. And this is going to diminish returns over time compared to what you could have done. Or what I often also see is that for whatever reason, an investor has sold their investments and they're sitting on a big chunk of cash. And they've been sitting on it for a long time. And they missed some really big returns in the market because they kept waiting to buy back in. And this is human nature, right? Because we're not naturally inclined to be good investors because we are built for fight or flight. This is what has kept us alive for thousands and thousands of years. But with investing, our temperament has to be the opposite of our instincts. And of course, that's very difficult, right? And there's always a reason to sell, right? Stocks are overvalued, the political climate is bad, the weather is bad, there's a war, etc., etc. But over time, investments generally climb a wall of worry. How do we prevent the behavior gap? We try by reframing perspective by doing the following. First, we want to create a plan. We construct an investment plan aligned with your goals, your risk tolerance, and your time horizon. And of course, this is going to help you stay focused on the long term rather than reacting to short-term market movements. Number two, we're going to stick to that plan. Once you've established an investment policy strategy, stick to it. Avoid making impulsive decisions based on short-term market fluctuations. And you're going to also want to regularly review that plan, but you want to avoid making drastic changes unless, of course, your financial situation or goals have changed dramatically. Often, if clients feel very strongly one way or another, we make incremental changes to their investment policy to help with their peace of mind, but this way they aren't necessarily making an all-in bet one way or another that could really throw off their retirement down the road. Number three, we're going to diversify, right? Spread your investments across different asset classes, stocks, bonds, real estate, etc., in order to reduce risk. Diversification is the only free lunch on Wall Street. Number four, automate investments. If you aren't retired or you are not living off of your investments, set up automatic contributions to your investment accounts. This is going to help maintain consistency and is going to prevent emotional decision-making during market highs or market lows. Number five, control emotions. Easier said than done, right? Because for most of us, money equals emotions, but fear and greed often drive irrational decisions. The fight or flight mentality that I was speaking about earlier, right? Well, that mentality is generally the opposite of what we want to do in the investment realm. Number 6, seek professional advice. Now, obviously, this one is self-serving for me, but I truly believe a very high percentage of people would be way better served with an advisor that focuses on their situation. And for us, that is for those that are in retirement or close to it. We can provide guidance, help you understand your risk tolerance, and keep you on track during turbulent market times. Many argue, including Vanguard, that this alone is worth the price of admission for hiring an advisor, helping manage emotions. Number 7, regular review and rebalancing. Now, you're going to want to periodically review your portfolio's performance and rebalance it if necessary. Now, notice I said periodically. Constantly monitoring can lead to impulsive decision and isn't going to do you any good anyway. It's just going to drive you nuts. So bottom line, remember, it's normal to feel uncertain about the market, but sticking to a well-constructed plan and avoiding emotional reactions can significantly reduce the behavior gap and improve long-term investments. After all, the Dow Jones Industrial Average has gone from 70 in 1900 to over 37,000 today. And in that time, we've had 2 world wars, a Great Depression, many recessions, an oil embargo, Vietnam, Iraq war, and many other conflicts, right? Et cetera, et cetera. So stay the course, and thanks for tuning in. Once again, Tim Doehrmann here, founder of Eagle Ridge Wealth Advisors. And if you would like to see how we help our clients get the most out of their financial lives in retirement, please visit us at erwealth.com, and we hope to see you there.